Today we will be talking about stock price, market cap, and the float right here. That's our topic, and let's get into it. So what is the market cap? So market cap, or in long form, it means market capitalization. Market capitalization, which means the total value of the company. Now, how do you calculate the total value of the company? It is the stock price right here times the outstanding shares. This one. Okay? So, how does this equate into, an example, for example? So, let's say one share, yes, make it this color. Let's say one share, let's say this is a pizza. And let's say one share is $10. Other share is also $10. Third one is also 10. Fourth, fifth, sixth, seventh, and eighth. Okay? And there are total how many shares? Meaning, outstanding means everything including. And by the way, when we are talking about the shares, we are talking about the common stock. Not the preferred stock. Not this one, okay? Only common stock. Now, common stock, we're talking about the common stock, okay? Now, it can be common stock class A, B, C, D, E, F, G, H, whatever. Common stock, okay? So keep that in mind. Every time we're talking about outstanding shares, we are talking about the common stock. Basically, common stock, technically for every type of stock market talk, because preferred stock have a separate section on the balance sheet of a company. It does not account for calculations and other things. So it's best to remove the idea of preferred stock out of your head unless you are on a whole different league of as an investor. So common stock, okay? That's one thing to notice. How many shares or slices are there? There are 1, 2, 3, 4, 5, 6, 7, 8. 8 slices, okay? That means we have 8 outstanding shares right here. And we are going to multiply that by the price. The price is $10. That means our market capitalization is $80. The total value of the company is $80. That is the market cap. Okay, now let's say we have, as an example, let's say we have outstanding shares of 10 in total, okay? And let's say the stock price is $10. So the market cap is going to be $100. Okay? Oh, sorry, 100. Now let's say the price goes up. Okay? The price goes up to, let's say, $15. So if the price goes up, the market cap will also go up also to 150 instead of 100. Okay? Now on the other hand, let's say if we put, let's say a government or like a huge institution is like, hey, you know what? We decide to buy $50 worth of this company, and they inject $50 more into this. So now, since the market cap just went up to 200, the price will go up also to $20. So you see the relationship of a stock price and market cap. Now let's say we have the scenario here where the market cap is 200, stock price is 20. Now let's say the company decides to issue more shares. Okay, they're like, you know what, we want to issue 10 more shares. So they decide to issue 10 more, which equate to 20 shares. So if a number of shares increase, of course that will affect the price. That means the price of the stock is going to drop to $10. So if the number of shares go up, that's a negative. That's a bad thing. If the number of shares go up, the price of the stock goes down. Okay? So the supply of shares outstanding shares go up, the stock price goes down, provided that the market cap or the demand stays the same, for the example. So that is your relationship of stock price, outstanding shares, and market cap. Now, there are different levels of market cap, okay? So, for example, mega caps, like there are many companies that we can name. Now we have trillion-dollar companies like Google, Meta, Tesla, Nvidia. They all fall in this category right here. And as an options trader, we want to trade these because these have relatively more stable and more predictable price direction. And we will get to that why. And we don't want emotional direction of the prices. So this is pretty good in terms of options trading. But for investing, let's see why different levels pose different risk and reward for each. For example, so we have mega caps, like those I'm talking about, the huge companies. Then we have, so they are anything over $200 billion, okay? And then we have large caps, which are typically between 10 billion and 200 billion, okay? And then we have mid cap between 2 billion and 10 billion. A small cap between 300 million to 2 billion. Micro cap between 50 million and 300 million. And then we have penny stocks or over-the-counter stocks right here. Okay, between $0, well, very small market cap, to 50 million. Okay, now let's do an example. Okay, so first I'm going to show you an example through my own example, and then I'm going to show you a simulation that I made. So let's say we are talking about a large cap, or let's do a mega cap. So let's say this company is worth 200 billion, okay? If I want this company to go up by 100% gain, Okay, if I want its price to go up by 100%, of course, if the market cap goes up by 100%, the price also goes up by 100%, provided that the supply stays the same. So let's say if I want the price or the market cap to go up by 100%, I would need to put $200 billion into the stock for it to go up. Okay? Now let's say another example. For example, let's say if I have a company which is $10 billion, okay? For this company to go up by 100%, I would need to put $10 billion of capital inflow. Okay, I would need to put $10 billion to inject into this company to buy the shares with that much of money, and the price will go to 20 billion. The market cap is going to go to 20 billion, which will result in a 100% gain. Okay, but now let's say I take that same 10 billion and I put that in a large cap company which is worth 200 billion. If I put 10 billion in a $200 billion company, that company is going to go from 200 billion to 10 billion. That means that company only saw a gain of 5% only. Here, on one hand, we have a mid-cap company with $10 billion market cap. We put $10 billion, it goes up 100%. But if you take that same amount of money, put it in a $200 billion market cap, that stock only sees a 5% gain only. So the type of tier that you are trading or investing in matters. Okay? Some people think that if the stock price is like, let's say, if a stock price of a $200 billion company is like $10, and a stock price of a $2 billion company is $100, people are going to think, oh, if I buy a $10 stock, it has more room to go up because this one looks more expensive. But that is not true. You see why? Because the market capitalization matters more than the stock price when it comes to percentage gain. Now let's say, taking that same example, let's say this $2 billion company, its stock price is $100 and this stock price is $10. Let's say I put $2 billion in this company. This company sees a $2 billion, goes from 2 to 4 billion, okay, and it sees a 100% gain. The stock price went from 100 to 200, okay? Got it? Now let's say if I take that same $2 billion inflow and put it in that $200 billion company, it went from 200 billion to 202 billion. Do you know where the price went? The stock price went from a whopping $10 to 10.0 1. Because that was only a 1% gain. So you saw a 1% price increase also. So you see how the market capitalization is very important to understand. How fast or how big the price of a stock will move has a lot to do what its market cap is. Okay, so that is very easy to understand. Now let me give you another example. So using AI, I created this simulator. So let's say the stock price is 10, okay? And in each tier, we are going to be putting, let's say, $1 billion. Or let's just say 100 million. I wish I could just put the number pinpoint. There you go. So let's say I'm putting $1 billion, which is 1,000 million. Let's say the starting price of the stock was $10. Okay, right here. And let's say each level of company gets $1 billion of inflow. So if a mega tier, which is 1,000 billion, which is $1 trillion worth of company, let's say Tesla, for example, if Tesla gets an inflow of $1 billion, okay, it only sees a 0.1% gain. Not even a 1%, because 1% had to be 10 billion. A company which is worth $1 trillion, okay, gets $1 billion inflow, only sees a 0.1% gain. So the price went from $10 to 10.01. So only 0.1%. So that $1 billion was not enough. Okay? Now on the other hand, a company worth $50 billion sees a $1 billion inflow of capital. That's a 2% gain. So the stock price went from $10 to $10.20. Okay? Now let's say we go even lower in market cap. Mid cap, if a company is worth $5 billion and it sees if it sees a $1 billion inflow from here, it will see a 20% gain. So the price went from $10 to $12, which is a 20% increase. Now let's say we go to a $800 million small cap company. It sees a $1 billion of inflow. Its stock price went from $10 to $22.51. That is a 125% increase. Now let's say microcap, a company that was initially worth only $150 million, 150 million only. Let's say that company gets $1 billion of inflow. The stock price is gonna go from $10 to $76.73 right here, which is a 667% gain. Now over the counter or penny stock, let's say if a stock with a market cap of only $10 million saw an inflow of $1 billion, which is very rare, and let's say its starting price was $10, its new price is going to be $1,000 with a 10,000% gain. So you see how different level of market cap reacts differently to the inflow of money. So in summary, the smaller the market cap, the easier it is to move the price. Okay? But also, it's also more risky. So now let's talk about the float. So we talked about the market caps. What is the float? So we talked about how the whole pizza is the market cap, right? Or outstanding shares. This is all the shares are outstanding. Okay? Float is what is available to trade right here. Float is what is available to trade. Now, let's say out of the 8 slices, 3 are either owned by insider holdings. Insiders mean like anybody who owns more than 5% or more shares. That person is an insider. Insider holdings can also be by the CEO, the inside employees, or admins, whoever. And also restricted shares, let's say if a company does an IPO and the CEO or the founders, they get their shares. Typically, those shares are locked for about 6 to 12 months. Legally, they cannot sell those shares, okay? So those are restricted shares. And then we have ESOPs, which are like employee stock ownership plans, and they have a vesting period of between 3 to 5 years. Meaning, sometimes the companies decide to pay their employees with stocks, pieces of stocks, without the voting rights, because early on maybe they don't have the money to pay their employees. So they're like, hey, do you want to take shares? And then after some years, you can sell those shares and cash out your equity. So those are ESOPs. Strategic holdings are like, they don't really want to, whoever bought it, they don't really intended it to trade. It could be the governments, for example. Let's say how United States government bought a good chunk of Intel, right? So those could be strategic holdings. And then we have treasuries, for example, like treasury stocks treasuries. Usually when the companies buy back their own shares from the market, or stock buybacks, it's called stock buybacks. Treasury. Now, it could include stock buybacks and other strategic ways to hold company stock in the company. But these type of stocks are not really available to trade on the open market. Meaning, these stocks are not really floating around to be traded. Okay. And the stocks that are being floated around to be traded are called float, or available shares for public and institutions to trade. So all of these, excluding, except for these shares, except for these, everything else is ready and is being traded on the open market because they're not restricted, there is no vesting, they're not being held for power positions like strategic holdings, they're not in a treasury, they're not held by insiders, things like that. Now, important things to note right here. So we know that float is the available supply to trade, okay? But that's not the full story. I will get to that. So anything less than 20 million shares is considered very, very low float, okay? And low float is easy to move because even from the outstanding shares, you have removed a good chunk of supply, and lower supply, remember early on, if we remove technically out of the outstanding shares, let's say let's say only 5 of them are actually available to trade, and when we get the inflow of new money, that money is competing against 5 shares, not the 10, because 10 is the outstanding shares and only 5 are actually able to be traded in the market. So out of all outstanding shares, removing any of the restricted shares or any of these type of shares, whatever the float is, that is what is being traded in the market. Now you don't have to do any of the calculations. Your broker is going to show you. You can find it on the internet. So I'm just showing you what is behind those words. So we are looking for low float, which is very easy to move the price. The lower the float, the lower the supply to actually trade, and it's more easier to move the price. Okay? I just gave you the example of capital inflow previously. So now consider every time there's low supply of stocks and it shrinks even more with lower and lower and lower float, that means it's easier and easier and easier to move the price, affect the price, okay? Now another thing is institutional ownership, okay? You can see institutional ownership on your brokerage too. It will show you right off the bat in percentage, but institutional ownership is telling you, let's say, if it says institutional ownership is like 10%, what it's telling you is that out of this whole pizza, let's correct that really quick. Okay. What it's showing you that if it's saying 10% institutional ownership, it's not saying 10% of the float. It's saying 10% of the whole pizza. Okay? So for example, let's say if a company has only 10 shares total outstanding, 5 are locked for some reason, and 5 is the float, the 10% is going to be from the total, not the float and not the locked. Okay? That means they own 1 share of the total. And let's say if they own 1 share, the float is 5, they own 1. So we're going to really think that the float is 4. Now the brokerage is going to show you 5 and institutional ownership is 1. The float, the active float or final effective float is really 4, because institutions, they don't really buy and sell emotionally. They don't panic. They buy and hold it for very, very long term, meaning when they buy it and keep it tucked away for years and years to come, meaning that stock that they just bought is out of the supply that is available to trade. So yes, float is what is available to trade, but you also have to kind of look at institutional ownership also. If the institutional ownership is very high, take that institutional ownership number and minus the float with the institutional ownership also. That will give you the real final effective float. That means we kind of just assume that institutional ownership is not really available readily for public to trade on a daily basis unless the institutions really have a reason to sell, especially like pension funds and long-term institutions. So that is one more thing to keep in mind. So like I said, and one point we also talked about is 5% ownership. If you own anything more than 5%, you are an insider. Okay? So keep in mind, again, one last time, the institutional ownership is the total of the outstanding shares, not of the float. So keep in mind. Now, what is the result of an institutional ownership? When this is what it looks like when there's a low institutional ownership. Okay? This is what the price might look like. But with high institutional ownership, the price is more directional. You can kind of predict a direction. And when they decide to sell, it's violent, it's fast, and it's directional. It's not emotional. So there are 2 types of volatilities: emotional and directional. So stocks with low institutional ownership are usually emotional because they're owned by everyday people, everyday retailers who are more emotional, more panicky, and more, they kind of get their decisions based on emotions. While on the other side, directional, institutions buy and sell very strategically. And when they strategize, they also cannot buy and sell all of their positions all at once. They have to kind of slowly deload their stocks or slowly buy up. And we will talk more about that also as we talk about block orders and dark pools and all of that. But this is the result of institutional ownership.